Today's cardinal lesson, we got the 2023 tax rates, and we got a whole board full of these, and we're going to talk about it, and we're going to add some meaning to it. Now, what I'm going to say right off the bat is people are looking at like 2023 tax rates. Why are we talking about those now? I haven't even done my 2022 return yet. And so if you want to go back and watch last year's video, it's up there on YouTube, and it has all the brackets and rates for 2022. And, you know, when CPAs and tax preparers and people that do them themselves, about the only time they look at these tax rates typically is in arrears, you know, in February, March, April, when they're doing the 2022 tax return in 2023. We're financial planners. We do work that is forward looking. So we're looking at your whole situation, and we're looking to the future, possibly 30 years into the future. But when it comes to tax rates, we're not going out that far because it's really hard to predict what they're going to do. But we're certainly going 5, 10 years out, and we're really specifically looking at next year. And, or if you're watching this video in 2023, we're looking at the current year, and we're looking at the brackets, where you fall. And I mean, that's, here they are. So we're going to talk about that. Now, we've also got the long-term capital gains and qualified dividend rates, which are different. They're lower, a little bit confusing. But if you're planning the sale of some stock, or you're planning the sale of a home or some rental property, or something's going to come at you where there's going to be a capital gain and you're going to recognize income, we're going to want to take this into account, and we're going to want to take your other income into account. Now, we've also got the standard deduction, which was greatly increased in 2017 under the Tax Cuts and Jobs Act. Actually, this was implemented in the tax year 2018, but they're significantly higher, and a lot of people using that. The annual gift exclusion is increased this year. And then we're going to talk a little bit about trust tax rates and brackets for 2023. And we're going to spend most of our time up in this upper left-hand box. And I really want to bring Tom in, and we want to talk a little bit about how we use this.
Yeah. And so one of the things that we have, and I'm going to bring up here in a second, is our show notes that you can find them on the link below our video. They're also on our website. But what we have done is we've, one, taken a picture of the board so you can maybe print it out, look a little closer. And then we also have in the show notes just these brackets laid out a little more in detail with the different types of, single filers, married filers, and things like that. So take a look at that if you guys want to look a little more closely there. But when we focus in on this ordinary income tax bracket, this box up in the upper left-hand corner, you can see that these brackets, on the left side, we have the tax rate. So the first, if we're looking at a married couple, the first $22,000 of income is taxed at the 10%. Between 22 and 89,450, it's taxed at 12%. And you just go down the list there. I want to point out a couple brackets, though, the 22 and 24%. So historically, these are really low brackets in terms of the percentage you're paying, and currently they're really wide. So a married couple currently can earn up to $364,200 of taxable income and only pay 24% tax at that highest marginal rate. I mean, that is a really low rate for quite a lot of income. One of the things I also want to point out, and a lot of people don't really realize this, our tax rates is you fill them up from the bottom. So everyone's first $200,000 or $22,000 is taxed at 10%. Whether you make $1 million or only make $22,000, that first $22,000 is taxed at 10%, and you fill the brackets up as you go. So a lot of people might think, I don't want to earn this, I don't want to get a raise, I don't want to earn more money, it will put me into a higher tax bracket. That's just not how it works. Is that if you're going to get a raise, I would always take it. Take the extra money. Yes, that marginal dollar, that next dollar might be taxed at a higher tax rate, but you still are going to be much better off doing that. So, I mean,
Well, and I think there's more people than you think, Tom, that think that, if I made $364,000, I pay 24% income tax on all my money.
oh
And
yeah,
if I make $1,000 more and I get to 365,000, I now pay 32% on all my money. And there's more people than than you realize that
Well,
think that.
I think there's a lot of people that think that for sure. I've heard it when I was growing up. I'd hear people say, "Oh, I don't want to get a raise," and it's like, "What do you know?" I didn't know, but now I've studied it. I know this, and it's silly. I mean, you should always take more money is better than less money. I think that's a good a rule of thumb.
That's a
But
good that's a good
um,
point.
yeah, and so the other thing that I want to point out with the tax rates is that that is taxable income. And so this becomes important when we're looking at doing Roth conversions or we're trying to plan for IRMA, which is that increased cost for Medicare, is, the IRMA is looking at your gross income. So if you earned gross 364,000, you'd look at this tax bracket and you say, "Oh, I'm in the 24% tax bracket." You look at the IRMA bracket, see what you pay there. When in actuality, if you're really trying to target that 24% bracket, you could earn more than $364,000 because of this box below that, the standard deduction. You get to reduce your income by, if you're over 65, if both of you are over 65, 300, $30,700, you can reduce your income by, which is really, very helpful in terms of reducing your gross income to the taxable income to look at the tax bracket. So it gets a little complicated. If you have questions, we're here to help. CPAs, your tax accountants, they can help run these numbers for you. But a lot of times CPAs are looking backwards, what you've already done. What we a lot of times do, we're planning forward and trying to project out those Roth conversions.
Well, I want to talk about single people too. So, if people come in here, 364,200 is the top of the 24% bracket. And we do have a lot of married couples plan around that number. We have also an amount where people will plan around the 190,000 number that are married. If you go over here to single, that number is just exactly half the top of the bracket. It's 95,000 for the 22% and 182,000 for the 24%. And so when we're doing Roth conversion planning, a lot of folks want to maximize this. So if you've got, if you're a single person and you've got 80 grand of income that you're just living off of, that you're paying taxes on it, whatever combination, and now you've got this big IRA and you want to look into Roth conversions and you want to take advantage of these lower, historically low tax rates, then you might choose the top of the 24%, which is 182,000, because your brackets are much smaller because you're just one person. Now, this also comes into play when we have a death of one of the spouse. So we need to plan for that too, because if you have a married couple, one of them is probably going to outlive the other. And so, that's not always, but, and sometimes that survivor lives a long time afterward. And so we need to plan for tax rates, and we need to show that that widow or widower is going to have a larger tax bill to pay if the income is the same or close to the same. And one added point to that is the year of death is kind of hard to go talk to a widow about this, or a widower. So we don't try to do that right away, but the year of death, there's an opportunity for a Roth conversion where you could use the married filing jointly tax rate. So we don't want to get too detailed, but we use these things prospectively and try to look at them to help people decide if they want to do Roth conversions or not, and then how much do they want to convert. And it's generally better to do those in smaller amounts over a number of years. Okay.
And I think that's a really good point with when we're looking at Roth conversions, especially people who have a large IRA. And so they maybe say, I don't really want to do the Roth conversions. I'll just take the required minimum distribution, the RMD, and just take it as I need it, which for the first several years is going to be fine. But looking forward, it's going to be a problem when that first spouse dies, because now your tax brackets essentially get cut in half. in terms of the income that you can earn, your standard deduction gets greatly reduced. And all of a sudden, you've left your surviving spouse, who is now, by definition, older than they are now. So their RMDs are higher than they currently are. They're having to file it at a single tax rate. I mean, it can cause a huge tax problem to not sort of think forward about what that might look like, 15, 20 years from now.
Oh, yeah. So now we look at these things for IRMA Medicare, and it just so happens that the top of the 22% bracket is close to the IRMA threshold. Okay. And, in other words, for 2023, it's more than 190, but we'll get into that in a different video. And it's for a single person, it's a little bit more than 95, but this is a pretty good place to just look at to do your income planning if you're trying to avoid IRMA altogether. Okay. And many times these two things get in conflict, where we're looking at Roth conversions, but at the same time, we're trying to avoid IRMA, or we're filing an appeal because the people just retired. So a lot of times when we get into tax planning, we have conflicting goals and objectives and strategies, where one's causing a rise in income and an increase in tax, and then that's driving them up and causing other taxes. So that's why our job is a little bit complicated, and it's why you might want to give us a call. But IRMA Medicare is a big deal to people. We want to point out something else, is that in 2026, these tax rates right here are going to increase, or they're going to go back to what they were before the Tax Cuts and Jobs Act was passed. So there was just a several year deal in the funding of that tax bill that brought these rates down. And starting in 2026, unless they change the law, these are automatically going to increase, and then the brackets will change. But the point being is, you've got 2023, 2024, and 2025, is you have 3 years where you can go to your bracket of choice if you're interested in doing Roth conversions. Okay. Now, the next thing we want to talk about is the tax rates here on long-term capital gains and qualified dividends. They're smaller and they have different brackets. And Tom, do you want to share with us a little bit of how this works?
Yeah. And so, these are taxed obviously at lower rates. Capital gains would be assets that are not in retirement accounts or things like that. So maybe investments in stocks or real estate, something that's not in an IRA or 401k. And what the capital gains are is you pay tax on the growth of those stocks. So you purchase it, let's say for $100. It grows to $200, and then you sell it, you have $100 capital gain that you have to pay tax on. And so determining what percentage you're in it's a little bit I don't want to say tricky, but what they do is they look at your income, your total income, and they look at these brackets to see where you fall into, and then that determines the top capital gains rate that you would pay. And so for people who maybe are just on Social Security, have very little other income, but they have these investments off to the side, you could really target that 0% capital gains rate and sell stocks that have grown, in a controlled manner, and really pay 0% tax. And so, people will come in. How do these really wealthy people pay very little tax? Is they're playing this game. Is they're at the top of the capital gains rate, it's 20%. Whereas if you look at the left side of the board, if you made a lot of money of ordinary income, that's 37% tax rate. So a lot of ways, and there's other things they're doing, but this is a big one, is that they are getting income based off of capital gains, which are taxed at lower rates. And so it's just something to be aware of, and just, nice to one of the things I would point out is, as you head into retirement, or if you're maybe younger and you're looking forward towards retirement, it's nice to have money in different buckets that are taxed differently, because that gives you a lot of control of where you pull money from. So you might have some Roth, some traditional, some taxable money, and you can really pick and choose where you pull the money from, and really kind of pick the tax rate you want and just aim towards that.
Well, sure. When we're doing estate planning, and we're talking to somebody who's maybe in their 80s and they have a substantially appreciated asset, and then they start talking about selling it, and they're well under the multi-million dollar federal estate tax bracket, so they're just an average person, um, and then they're talking about selling it. Well, sure, they can sell it and pay capital gains taxes on the appreciation, maybe at lower rates than their kids. But if they hold the property until after they die, they get a step up in basis, and their kids, if they sell it after their death, are going to have a 0% gain. I mean, they're going to have no gain because it. So I don't want to get off on estate planning, but we use these tax brackets and our understanding of them in all the planning we're doing just for everybody, all up and down the cycle. So I want to also point out something. I think what Congress and the tax writers were really thinking here, if we have a married couple or a single person that incurs a small capital gain and they don't have a bunch of other income to drive them up in the brackets, they don't want them to pay any taxes on that capital gain. I mean, they just, so you can make a $20,000 capital gain if your income is low and just pay no taxes.
I will say the other thing where capital gains come into play as well is real estate. So especially your home. So if you own a home and then you sell it, one of the nice things that's in the tax code is they let you exclude for a married couple up to 500,000 of gains. For a single filer, it's 250. But we get the question a lot: is okay, I'm selling my home. I bought this 20 years ago. It's grown a lot. Am I going to owe taxes? And so it always depends on what the numbers are, but it's nice that if your house hasn't appreciated for a married couple more than $500,000, you don't pay any long-term capital gains on that. I mean, it's
Or
just
you just pay capital gains on the amount that it's appreciated over 500,000.
right.
And that amount gets plugged into all of this. That's surprising news to a lot of people. It just is. It's a welcome thing. Is this 250 grand on a home sale? But then we advise people a lot too. People say, "Oh, I'm going to rent it. I'm not going to sell that." Well, you can only take the $250,000 capital gains tax exclusion for the sale of your home if you've lived in the home 2 of the last 3 years. So
2 of the
there's
last 5 years.
what's that?
It's 2 of the last 5 years.
2 of the last 5 years. Yeah, I probably didn't say it correctly. So don't try this stuff at home. We're spitting out a lot of stuff and we're not giving you all the footnotes. So we're just trying in this video to show you, is we await these things coming out every year, and then we produced it this year on our own, uh, just the chart and pulling out the key stuff, and we can advise you on all of this so that you time and you make the decision to buy or sell or recognize income or convert Roth. This is the fundamental chart that we use. Okay, so now let's talk a little bit about the standard deduction. And I will just say at the opening that I think that I'm hearing in the news more and more that this large standard deduction has been prevalent for like 4 years now. And you're hearing more and more people are aware that they're taking this. But there's still a lot of people in the dark. I mean, for a married couple who's over 65, $30,700 is a pretty large standard deduction. What do you have to say about that, Tom?
Yeah, I mean, I think some people, and when we were, and this was more prevalent a couple years ago, but we don't file people's taxes, but we can kind of help gather things and get it to a CPA, and they'd be bringing in boxes and boxes of, say, like medical bills or their home interest, or they maybe gave, $5,000 to the church or something. But when you start adding it all up, it's nowhere even close to the $30,700 that it is now,
Or the 15 if they're single.
or the 15 if they're single. And so they were doing all this work, keeping track of things that just it didn't matter because the standard deduction was higher than what they could do from an itemized. And so this was a big change in the tax code. I think part of it was probably to try to simplify things, try to keep it where you're not having to keep track of so much stuff. some people who are getting a benefit from giving to charity. This isn't a reason to not give to charity. If you're charitably inclined, please still give, but just know that you might not be getting a tax break if you're not going to. And we'll talk about a QCD in a second, but just normally just giving to them directly, you might not be getting a tax break for that.
Well, yeah. And so let's bring up the QCD. So QCD stands for qualified charitable deduction. And it's available if you have an IRA and you're 70 and a half or older. And every year after that, you can donate directly from your IRA to a charity, and it doesn't show up on your tax return, or maybe it's going to show up, but it has a corresponding zeroed out amount. The charity doesn't pay any tax on anything that they receive. And so you can effectively do your annual giving through your IRA for every year after that. And you still take the standard deduction. So it's like you're getting credit for it twice. And we have several clients and people that we advise that are giving large amounts, and we've shifted them over to using the QCD. And with the new year rolling around, again, don't try to do QCDs on your own, because if you have about 10 steps you need to follow, and you miss one of them or you do something wrong, the whole thing can get disallowed. So, again, we're just going over things generally. Now, the annual gift exclusion, this is another area of most people out there, if they know about this, they think, well, isn't there some amount that I can give to my kids, but I can't exceed that amount? And it's something like $15,000. Well, what they're referring to is the annual gift exclusion. And now in 2023, that's going to be 17 grand. Okay, so the 17 grand is the amount that if you have money to give away, you can give it. Most people give it to their kids and maybe their grandchildren, and you can give away 17,000 in a year or in 2023 to each person. And then if you're married, you can give 17,000 to little Johnny, and your spouse can give 17,000 to little Johnny. And if you're trying to maximize this gift exclusion, you can give 17,000 to little Johnny. Your spouse can give 17,000, and then if little Johnny is married to his wife Sally, you can each give her 17,000. So there's a way to use a multiplier with this. But the reality is, the only thing you're avoiding here is a gift tax return. Because if you just gave them a larger amount than that, you would have to file a gift tax return, of which most people filing a gift tax return owe no tax anyhow. So we'll get into that in another deal with estate planning. I just want to know that what you've thought in the past was like 15,000, it was 16,000 last year, it's now $17,000 is the annual limit on gifts. And the last set of tax rates we want to go over is the trust tax rates. So I'm going to let Tom talk about that a little bit.
Yeah. And so if you see on the board here, you can tell that these trust tax rates are really low. I mean, to get into, well, let me rephrase that, is the income you can make to get to the next bracket is low. And so they're actually really high rates. And so you get to the 37% tax rate if the trust makes above $14,450, you're in every dollar above that is taxed at 37%. Compared to even a single filer back on the upper left hand corner, that 37% doesn't start until $578,000. And so you get to those top brackets very quickly inside trust. So of everything out there, trusts are one of the most least taxed tax advantage types of accounts you can have. Is the taxes in them are really high. And so where this can become a problem, it can become a problem in several different ways, but we've seen a lot of people recommended to name their IRA beneficiaries as this trust because they want to have control over the money after they die. And there's reasons to do that. So I'm not saying you should never do that, but you need to think there needs to be a really compelling reason before we would recommend doing it. Because if it's one, it needs to be set up properly, which a lot of them aren't. And even if it's not set up properly, every income that's received in that trust is taxed at these rates. And it gets really bad because then you have to look at the new Secure Act, which we have several videos on. At some point, that whole IRA is going to be distributed to the trust, and all of it would be the remaining amount would be taxed at 37%. It's just not a great way to leave money from a tax standpoint.
Okay, so what I want to throw in there is this doesn't mean trusts are bad or they're taxed extremely high, because there's one way to get around this with a trust is to distribute the income inside the trust to somebody. So this is a revocable living trust that you're wanting to get into for other reasons than tax reasons. Is the income is going to flow back to you, the grantor, or your spouse, and you're going to be taxed on that income at ordinary rates. So you're fine there. Then if the trust income is paid out to one of the beneficiaries of the trust, again, if it's set up properly, you can avoid this high trust tax rates and these high or low thresholds, essentially, simply by distributing the income in the trust. But then that doesn't work for some trusts. They have a need to accumulate income, that it's maybe the person is too young or they have to have flexibility. So anytime you have a trust that's accumulating income, somebody's got to pay taxes on it, and it's going to be the trust. And if it is the trust, it's at these rates. So consequently, what we do a lot of times is we use either a life insurance policy or an annuity to hold a lot of the income that's accumulating inside the trust, because the trust itself can be the owner of the annuity or the life insurance. And then the income accumulates tax deferred, essentially. And then when it's distributed, we distribute it to a person. So we're getting into a little advanced stuff. I just want to point out, I just want to show these, because a lot of people are just going to look right past these trust tracks. Oh, that doesn't apply to me. It can, and there can be situations where you're setting up a trust or somebody's recommending, and then we got to look at the taxation of it. So what I want to do, in just kind of summarizing, is we look at taxes, and if you'll notice, the taxes are the last of the 7 worries that we talk about in all our video series. So obviously we talked about it last, and the reason I put it last is I don't think that saving money on taxes ought to be the whole focus of what we're doing in our financial planning. So that's why we put it at the very end. But it's part of when we're talking about all these other things. I mean, we've talked about estates today, and we've talked about transferring money to the next generation and the taxation. We've talked about income and income generation and income taxation. We've talked about IRAs a lot. When that is one benefit with an IRA is you're in control of when it's distributed. So you can play the game within the bracket game. We haven't really talked about long-term care. We talked a little bit about Medicare, because you got this Medicare tax called IRMA, and we haven't talked much, but a little bit about Social Security. So I think that's about all we have for today. I want to thank you. I'm Hans Scheil, and I want to thank you for listening.
And I'm Tom Griffith. Thank you.